All right, so for this video, I'm going to talk a little bit about early and late retirement. So the full retirement age is presently age 67 for those born in 1960 or later. Retirement is possible under Social Security at age 62, but if you retire before age 67 for those who were born in 1960 or later, then their benefits would be reduced if they're retiring prior to age 67. So for the first 36 months of early retirement, the benefits are reduced by 5/9 of 1%. So 5/9 of 1%, which works out to a full 20% for the full 36 months. So if you retire a full 3 years before the full retirement age, then your benefit amount would be reduced by 20%. If there are additional months of early retirement, the benefits are reduced by 5/12 of 1%, which works out to another 10% for a full 24 months. So if you retire the full 5 years, age 62, prior to the full retirement age of 67 for those born in 1960 or later, then what that would result in would be a full 30% reduction in the benefits received. So 20% for that 36 months, the first 36 months of early retirement, and another 10% reduction for the next 24 months of early retirement. Now, on the other hand, if a person delays retirement after the full retirement age, for each year after of delay, the benefits are increased by 8% per year for those born in 1943 or later. So delaying a year increases your annual benefit by 8% per year of delay for those who are, again, born in 1943 or later. So what you could then do is actually do a time value of money calculation and compare the present value of expected benefits for different retirement dates. And basically what would happen there is if you delay, you get fewer years of benefits, but the benefit amount is larger. So you can actually kind of compare what the present values are for the different retirement dates and see which retirement date would have the highest present value. The challenge with that is it does involve expectations of how long a person would live and things like that. So that starts to affect this. If you expected to have a very short retirement and then die, then in that case, claiming early might make more sense because the reduced amount of benefits might well be offset by the fact you claim more years worth of benefits by claiming earlier. On the other hand, if you're somebody who is going to live to 110, well, waiting a few years and then getting 8% extra for each year that you wait after the full retirement age starts to make a lot more sense because you have a lot of years to get that extra 8%, and therefore it likely makes sense. So it's also worth noting that if you are working while in retirement receiving Social Security, then that actually affects the amount of Social Security as well. So there's a retirement earnings limitation. And basically what that means is your benefits are reduced by $1 for every $2 earned above a specified threshold. And there are some different rules that actually apply for the specific year that the retiree reaches what's considered to be full retirement age. So there's some special years there, or special rules there. But basically, if you're still working and claiming the benefit, then the amount that you actually would receive are actually going to be affected by the amount that you're working. And the kinds of things that would affect that would be things like wages, self-employment income. And so basically, if you earn above a certain amount, it starts reducing your Social Security benefit. Dividends and interest from investments and pension retirement plan income does not count in a way that would reduce your Social Security benefit amount. And typically, if you are facing a situation in which they're expecting to reduce your benefit, so if there's the expectation that you would need to reduce the benefit in the next year based on how much you're working, then likely those reductions are going to be withheld at the start of the year, which may mean that you face a situation where the first month or two possibly, who knows, maybe more, of your Social Security payments are essentially withheld to account for the reduced amount. So you could have sort of a very uneven amount there. So instead of that reduction occurring gradually throughout the year, you could have a big drop for the initial first few months, and then basically you get more later. So that can make planning interesting from that standpoint. Okay, hopefully this little discussion about some of the ramifications of early versus late retirement and how they relate to Social Security has been helpful. Thank you so much for watching and have a great day.